Debt investment strategies. Building wealth with fixed income assets. Investing in debt instruments has long been a reliable strategy for wealth preservation and steady income generation. Unlike equities, which offer potentially high but volatile returns, debt investments provide a structured approach to earning interest while mitigating risk. From government bonds to corporate debt, a well-diversified debt investment portfolio can offer both security and attractive yields. In this essay, we will explore key debt investment strategies, their benefits, and the risks involved. Understanding debt investments. Debt investments involve lending money to entities such as governments, corporations, or municipalities in exchange for periodic interest payments and the eventual return of principal. Common debt investment vehicles include government bonds, corporate bonds, municipal bonds, and fixed income securities like mortgage-backed securities and treasury bills. Each type of debt instrument carries a different level of risk and return, making strategic selection crucial for investors. Key debt investment strategies. 1. Buy and hold strategy. One of the simplest and most effective debt investment strategies is the buy and hold approach. Investors purchase bonds or fixed income securities and hold them until maturity, benefiting from consistent interest payments while preserving principal. This strategy is particularly appealing to conservative investors seeking stability and predictable returns. 2. Laddering strategy. Bond laddering involves purchasing multiple bonds with staggered maturity dates. This strategy ensures liquidity at regular intervals while reducing reinvestment risk. As bonds mature, investors can reinvest in new bonds at prevailing interest rates, balancing risk and return effectively. 3. Barbell strategy. The barbell strategy involves investing in a mix of short-term and long-term bonds while avoiding intermediate-term debt. Short-term bonds offer liquidity, while long-term bonds provide higher yields. This strategy allows investors to adapt to changing interest rate environments while maintaining a strong fixed income portfolio. 4. Active bond trading. More aggressive investors may engage in active bond trading, buying and selling bonds based on interest rate movements and market conditions. This strategy requires deep market knowledge and risk tolerance, as bond prices fluctuate based on economic factors, inflation rates, and central bank policies. Benefits of debt investments. Debt investments offer several advantages, including 1. Stable income. Regular interest payments provide predictable cash flow. 2. Capital preservation. High-quality debt instruments, such as government bonds, offer a secure way to preserve capital. 3. Diversification. Adding debt securities to an investment portfolio reduces overall risk by balancing equity market volatility. 4. Lower risk. Compared to stocks, debt investments generally have lower risk, especially when investing in high-rated bonds. Risks and considerations. Despite their advantages, debt investments are not without risks. Investors should consider 1. Interest rate risk. Rising interest rates can reduce bond prices, affecting market value. 2. Credit risk. Corporate and municipal bonds carry the risk of issuer default, impacting interest payments and principal repayment. 3. Inflation risk. Inflation can erode the purchasing power of fixed interest payments over time. Conclusion. Debt investment strategies provide investors with a range of options to achieve financial stability and consistent returns. Whether through conservative buy and hold methods or dynamic trading approaches, incorporating debt instruments into an investment portfolio enhances diversification and reduces overall risk. By understanding key debt strategies and their associated risks, investors can optimize their portfolios to achieve long-term financial success.